A few more people join here and we will get rocking and rolling. Awesome. At least for the Ohio folks, I hope you're appreciating and enjoying some of this sunlight. You California folks are often what's the right word? Smart or spoiled? I don't know what to say there. You guys got to figure it out. You cracked the sunlight code. We're just we're getting a nice flavor of it here in Ohio finally. All right. So just want to make the disclaimer that Wes is probably going to join us here in a little bit. He is out at a conference in Las Vegas, and he was waiting for the conference to actually get going. And there's a little huddle room that I think he's going to break away and try and join the conversation. So he may be joining us as we start working through some of the material and the content and the discussions that we wanted to have today. But with that, I'm going to jump into it. Dad, how you doing today?
I am good. Everybody's looking good. Cameras are working well.
All right, good deal. And as always, guys, we want to make this interactive. We had a couple client submissions in terms of comments, questions, requests for topics today. If anybody has a question, if you're brave enough, you could feel free to turn the mic on and ask it. If not, no problem. So I know one thing that's on everybody's mind is the topic of, well, I guess it's twofold. First, tariffs, right, and how that relates to the new administration, what they're doing, and ultimately how that's affecting the markets, or if it's affecting the markets, and to what extent it's affecting the markets, right? So we wanted to have a little bit of a chat about that today. And then what we will hopefully have time for is to do a quick whiteboard session and remind ourselves of the fundamentals as we kind of approach a correction territory. Even though the market it looks like it's in the green today, we want to make sure that we are reminding of ourselves of the fundamentals of portfolio construction, particularly as it pertains to retirement planning, right? And see if there's good reason to change what we're doing, to tweak anything, or if we have this already baked in and already planned for. So first, I want to discuss the big conversation, which is tariffs, right? I will try to keep this as politically neutral as possible, but as soon as you start talking about tariffs and the new administration, you're going to bring up emotions. Both, they're very polarizing, both very good and very bad, right? Some people love Trump and the new administration. Some people can't wait till he's gone and out of politics forever. But nonetheless, we're in the environment that we're in, and we're dealing with the set of circumstances that we have today. So again, with trying to be as politically neutral as possible, we want to just touch base on what we believe the tariffs are impacting, if anything, to what extent they're impacting the way that we plan, and ultimately just have an open discussion on it, because it is on the top of a lot of people's mind, right? We have fielded many questions and held many conversations over the past couple of months about the new administration. Will they impact returns in our portfolio? Should we be doing anything differently in our retirement planning? And we'll talk about some of those things today, right? So to start, and please, I am not trying to be political here, but in terms of some of the messaging that the Trump administration has put out there in terms of tariffs, it seems as if with respect to certain countries, they want to do what are called reciprocal tariffs. So for instance, if China places a tariff on the steel that we would potentially import, right, and we don't have one in return, right, on balance, or you take that at face value, it seems like China's getting the better end of the deal than us. And by the way, that's just an example. I'm not saying that that's necessarily happening, right? So just to kind of highlight the conversation of what's going on, right? The idea of reciprocal tariffs seems to make sense to me. I think where where people get really polarized and at times rightfully so is the messaging around it, right? What I could tell you, and this is not necessarily a comment on Trump. This is just a general comment from us and our team. The tactic of bully ball is not necessarily, my favorite way to go about things or to get your way. But again, taken at face value, reciprocal tariffs aren't necessarily, destructive or a bad thing, right? There's been plenty of chatter, plenty of talk. Is he using it as a negotiating tactic? Are they actually going to implement some of these things? I think that's why the market is reacting the way it has reacted over the past couple of weeks. We actually don't know, right? So how much of this will actually be implemented, actually go into effect, versus how much of it is for headlines and political banter? Our personal beliefs, across the team, right or wrong, right? We don't know what the outcome of these tariffs will be, right? Right or wrong, the uncertainty is why people are quote unquote hedging their bets, right? Um, I don't want to get crystal ballish. I don't think we should start to predict what's going to happen over the next, 2 weeks, 4 weeks, 8 weeks, 6 months, 12 months because of tariffs. Here's one thing I would like to reiterate, and we believe this very, very firmly when it comes to business and business valuations, which the stock market is ultimately measuring. Regardless of tariffs, regardless of the sitting president, regardless of political, headlines, tailwinds, headwinds, whatever you want to call it, Costco and Coca-Cola and Home Depot and Microsoft, I promise you, have woke up today saying, how can we be better at business regardless of the political landscape this year, right? Now, if we want to talk about the other side of the aisle for just a second, we could go back to the Biden administration and when inflation was going 40-year highs, I think is what we cracked at one point. You had all of the people on the right saying it's the politics as the cause of it. Whether that's true or not is not what I'm here to debate, right? And today you have people on the left saying, oh, the talk of the tariffs, right? The new administration, that's the reason that the stock market's fluctuating. Well, I can promise you this. Costco wants to sell more memberships, sell more goods and services, regardless of tariffs, regardless of supply chain crunches, regardless of inflation, regardless of Biden or Trump or anyone else for that matter, right? And I want to regain our focus on what we're investing in. We are not investing in political banter. We are not investing in the Trump administration or the Biden administration or any other administration for that matter. Yes, governance is important. Yes, governance matters. But at the end of the day, we're investing in business. And the only way that business will continue to survive is if they continue to add value to the marketplace. If Coca-Cola no longer adds value to people in the marketplace, the valuation of the company will eventually reflect that. They will suffer from a financial standpoint over a long enough time horizon. Right. And we've seen plenty of examples of this in the past, right? JCPenney is no longer serving the market like it once used to back in the 90s, right? For example, or the 80s or 90s. It used to be the staple of retail shopping, right? I'm sure many of you fine folks on the call today, it's been a while since you've been inside the walls of a JCPenney, right? And for good reason. They are no longer as valuable to the marketplace as they once were, right? So as confusing, as frustrating, as whatever adjective that you kind of want to insert in there, the tariff talk will not get in the way of businesses waking up and trying to solve the problems that they otherwise would have if it were Biden or anyone else for that matter, right? So again, without trying to get too political, these tariffs will be just like the headlines of the past. A couple of years ago, it was inflation. A couple of years ago, it was a supply chain. A couple of years ago, it was Brexit. A couple of years ago, it was COVID, right? There will always be a new headline because fear sells better than anything else, right? And I just always want us to regain and recalibrate our focus on what actually matters. At the core of your investment accounts is value production. Right? That's the core of it. It's not Trump. It's not Biden. It's not inflation. It's not tariffs. At the core of your investment is Coca-Cola providing a valuable good, or Costco providing a valuable service to the marketplace, and them being able to capture part of that value to continue to grow their company, right? So I know that's kind of a long-winded intro to the, I got a couple more people I need to let in here. A long-winded intro to the tariff talk, but what's the opportunity here that we should start to consider, right? It won't be a recommendation for everybody on this call, but if you want to follow up with us and talk to us about, is there a potential opportunity to do some tax planning things because prices are suppressed by, roughly 10% right now, we can have that conversation. I want to circle back to that in a bit. But John, and appreciate you, John. You typically have a client submission for, questions, comments, things to table for the roundtable here. The crux of John's question is there anything that we should be doing, right, with the market turbulence? I want to point out I don't want to downplay the turbulence, right? It is roughly 10% off of all-time highs. But make no mistake about it, it can get much worse, right? And I'm not allowed to promise anything, and for whatever reason, compliance doesn't seem to care as much about promising the negative as the positive, right? But it's not a matter of if another 2008 will happen. It's more a matter of when. Will we all be alive for it? Who knows, right? No one has a crystal ball here. But 10% declines off of all-time highs are not near the bottom of the turbulence that we've all experienced as investors, right? We don't have to go too far back. 2022 markets were down, depending on the index, but roughly speaking, 20%. So, another 10% down from where we would be currently. And in 2020, it was short-lived, but at the bottom of COVID, prices were down about 35%, right? We don't have to go back too much further than that to 2008, where, again, depending on the index that we're discussing, prices were off all-time highs by about 50%, right, in the equity markets. So there is no doubt that turbulence can not only sustain itself here, but get much worse. By the way, that's not a prediction, right? I'm not suggesting that prices are going to fall 50% like 2008. I don't want to scare anybody, right? But there's always that potential as an equity investor. So this is where we go back to why we construct the portfolios the way that we do, right? And really, we don't just want one portfolio. We want 3 sub portfolios. So with that in mind, I'm just going to remind this of us, and I'm sorry to talk, maybe ad nauseum about this. And many of you have probably seen a version of this in the past. But it's really important, especially when prices start to drop, that we remind ourselves of the fundamentals and we don't make emotional decisions, right? Because that bad behavior is one of the worst things that we can insert to our financial planning, to our retirement planning. I'll back that up with some charts and some graphs later. But first, a quick whiteboard session on how we structure things to ensure that we have some agility and some nimbleness built in when inevitable turbulence like we're experiencing today shows up and becomes our actual reality, right? We appreciate everyone on this call. You're not a robot. It would be inhuman to see your account balance at the start of January be $1 million and today be 900,000, and you just think like, oh, this is great, right? You're not a bag of chemicals. You're a human being, right? And the way that we have evolved over time is we are not very comfortable with negative, right? We don't like bad things. That's why the human race has survived as long as it's survived. When bad things happen, our tendency is to make them stop, right? But when it comes to investing, this is actually problematic, right? So we want to design a portfolio that is structured in a way that you can withstand the inevitable turbulence. Right? Part of being an equity investor, part of being alive, part of being just a human being is that asset prices will fluctuate, right? You want them to fluctuate. If they don't fluctuate, then you just have a checking account that never goes up, right? Because volatility is not always negative. Volatility is a deviation from the mean, which means it can go up as well, right? So price fluctuation is in our benefit, but we have to attach the appropriate time horizon to that strategy, or else we can be in trouble, right? So as a refresher, and again, many of you have probably already seen this, maybe a few times, but as a refresher, now that turbulence is back in a relatively material way, right? We want to create sub portfolios inside your investment accounts, right? So it might just be one account, yes, but we want to break it up based on duration. So we have short-term assets, medium-term assets, and long-term assets. Right now, you guys know we're here in Kent, Ohio. You know, Wes he's in Las Vegas today. Let's just use his current destination. If I needed to get to Las Vegas by this evening, there is only one vehicle that I can take. It doesn't matter what my emotions or what my comfort level is around that vehicle. The only way I'm getting to West by dinner time is if I go right now, get in an airplane, and fly to Las Vegas, right? So the vehicle really needs to be relevant to the goal of the dollars, right? And the time horizon that we have to invest them, right? I'm going to go back to the airplane analogy. If the goal is to get to Las Vegas and we want to do that today, right? There is only one vehicle that will accomplish this goal. If we take or try to take any other vehicle to accomplish this goal over this time horizon, it's a guaranteed failure, right? The risk is 100%, right? So to bring it back to our investment portfolio, the vehicles in which we use inside the investment portfolio need to be relative and need to be contextualized to the goal and the time horizon of those dollars, right? So if the goal is I need $5,000 this month for lifestyle and expense needs from my portfolio, well, our recommendation would never be to invest that money in real estate, right? Just to use an extreme example. It's illiquid, it could go down, right? Hard to get your money back out, et cetera, right? So the vehicle would never be real estate if that's the goal and that's the time horizon. That doesn't necessarily make real estate a bad investment, but relative to our goal and our time horizon, it's not the appropriate vehicle, right? So in finance, nothing is really inherently good or bad. The application is where, you know, the rubber meets the road. So short term and our planning process is 1 year. Medium term is anywhere from 2 to 5 years, right? And long term is 5+ years in duration, right? So these sub portfolios, particularly in a time like today, when there's been some pretty material volatility, right? It's good to remind ourselves of why we're carving up the portfolio the way that we do, right? Anything that you would need or rely on out of your investment accounts over the next year, we want to keep them in some sort of liquid cash account. Could be a money market, as long as we have access to it, because the goal is not to get an extremely high rate of return, right? The goal is we want principal protection and we want liquidity, right? Because the purpose of those dollars is, again, not to fetch a rate of return. The purpose of those dollars is to fund our lifestyle and our expenses this calendar year, right? Wes has a great saying when he talks about result before return, right? Anytime that I tell somebody that I'm a wealth advisor, that I'm a financial advisor, anything of that nature, the first thing that they want to do is they say, oh, what should I be investing in? Or what rates of return do you average? Or, something around the price of assets. And I tell them, well, that's a very relative question. What are the goals and what are the time horizons? Then I could answer, correctly what a reasonable expected rate of return would be, right? So if the goal is this year, right, to fund lifestyle and expense needs, keeping the money in cash is really the only prudent or responsible option, right? And then 2 to 5 years, this is where we use debt instruments. And I say that word, and a lot of times people will give me, a little bit of a puzzled look, and they'll say, well, I don't want, I'm nearing retirement, or I'm in retirement. I don't want to go in debt, right? Well, I don't want you to go in debt either. That is not what we're referring to here. A debt instrument is someone is in debt to you. So think of a CD at a bank, right? Or a treasury bill. or an individual bond, for example, right? If you open up a 12-month CD at your bank and you put $50,000 in there, the bank owes you that $50,000 back plus interest 12 months from now, right? So you know to the day and to the decimal what the return on those dollars are going to be, right? Roughly speaking, right now, somewhere between, let's call it 4 and 5% that you can get for loaning your money out, right? We want to think of our cash and our cash equivalents as a multiple of your expenses. So what you're actually going to need from your investment account over this time horizon. Again, roughly 1 to 5 years in duration. The reason we don't want to go out further than that, and believe me, there is a strong human urge when markets start dropping to take dollars out of our long-term account, which I'll get to in just a second, right? And say, hey, I don't want to lose anymore. Let's put more in bonds, or let's put more in cash, or let's do something like that. We'll talk about the dangers of that in just a second, right? But the reason that we don't want to get too heavy-handed on the cash and cash equivalents is because one thing that I always keep coming back to with our planning clients, we don't want to think of our dollar bills in terms of units of currency, right? So what that means is a $20 bill has been a $20 bill your entire life, right? It's always been 20 units of United States currency since the day that you were born. It is today. It will be in 10 years. But in terms of purchasing power, that's not the case, right? Just think back to when you first started driving. How much gas could you put in your car for $20? You could probably fill up your car and someone else's, right? When you first started driving. Today, that is not the case at all. How much gas do you get for $20 if you pull up to the tank? Even here in Ohio, where gas is literally a couple dollars a gallon less, you can maybe at best get half of a tank of gas for $20, right? So units of currency, the $20 bill stayed the same your entire life. Purchasing power, right? The purchasing power of the dollar has diminished over time, right? So again, we want enough cash and cash equivalents to get us through the turbulence. It takes all the pressure off of our investments that, yes, can fluctuate in price and fluctuate downward sometimes, like we're experiencing right now, right? We don't want any pressure on that. And the runway is 5 years for a reason. I'm going to get to a chart that I think will reinforce this in just a second, right? But once we structure our portfolio to have enough dry powder, right, to have enough cash and cash equivalents to get us through a 1 to 5 year period, that gives us the privilege. And now we can responsibly own, whether it be real estate as an investment, so not your primary residence, a private company that you own and operate as an investment, or largely what we're doing with most people on this call, public companies as an investment. And again, I deliberately say public companies and not the stock market, because we're not investing in the stock market. We're not investing in the politics. We're not investing in the tariffs or the inflation or any of that stuff. What we're investing in is we're investing in public companies that deliver value to a marketplace, right? The reason that we continue to invest in long-term ownership assets is over a long enough time horizon. These are the only vehicles that can keep up or outpace inflation long-term, right? We've racked our brains on this. There's really only two ways, in our opinion, right, and at least in our experience, that you can keep up or outpace inflation long time, right? You could keep working, right, because your wages will rise commensurately due to inflation, right? So you can continue to work. Or if you want to retire, like most people on this call, you have to own the companies that are inflating the cost of their goods and services that they're selling, right? So I don't know if anyone on the call has experienced this, right? But I went to the grocery store last week and I love eggs. I eat eggs probably, I don't know, 3 or 4 days a week, something of that manner. And to be honest with you, and I don't want to seem like I have my nose in the air, pretentious. I had heard about all of the rising egg costs. I didn't see it till it kind of smacked me in the face at the grocery store the other day. It's like I went and it was just for kind of middle of the road eggs. It wasn't even like the super fresh, super organic, free range, et cetera. Just kind of middle of the road eggs that I typically buy. And it was like $8 a dozen. Now, some of you in California are probably laughing at like, that's it. Like, I'd love to pay $8 for a dozen of eggs right now. But it's a massive increase on a cost of the same dozen of eggs that I used to buy for $2 or $3 a dozen, right? Now, as a consumer, yes, I am very worried about inflation. As an owner, right? Do you think the owner of that grocery store took a loss on selling that dozen of eggs? Right? Absolutely not. Because what did the owner do? He or she passed the inflation through to the consumer. If it used to cost them $1 to buy that dozen of eggs, they'd turn around and sell it for $2. Right now, it costs them $5 to buy that same dozen of eggs. So they turn around, they pass the inflation through the consumer, and they charge the consumer $8. Right? Same thing at the gas station, same thing at Costco, same thing at Microsoft, same thing at Apple Computer, so on and so forth. So as the owner, yes, we are assuming more risk in the short to medium term, but we get the benefit of passing through inflation to the consumer long term, right? So as the cost of business rises, we increase the cost of the goods and the services that we're selling, and therefore, right, the real estate property will rise in value, or the public company price will rise in value, et cetera, right? So if there's any actionable takeaway from this, right, if you're unsure or you're uncomfortable with your sub portfolios in your investment account, contact us, right, so that we can review, hey, do we have enough cash and cash equivalents on the sideline so that our long-term portfolio can stay intact and we're not disrupting it during a time of turbulence, during a time of, a 10% correction, or, at some point in time in the future, potentially worse, right? If right now you could go to your cash and your cash equivalents inside your investment account and get your lifestyle and expense needs without disrupting the long-term portfolio, right? Now you're in good shape because you have taken all of the pressure off of your real estate or your private company or your public companies to perform and to produce for you, right? So we will just shift where we get our cash flow from in our investment account to the cash and the cash equivalents. I actually have a great chart that I didn't know was going to fit so, seamlessly with this discussion, right? But I think this really hammers home the point, right? So when you're talking about the S&P 500, right now, this is the period 2004 to the end of 2023. So basically 20-year period here, right? And if you invested $10,000 into the S&P, right, in 2004, and you just left it in there the entire time, right, your 10,000 turned into almost $64,000, right? But if you missed just the best 10 days over that 20-year period, right, your $10,000, now the investment results are, it drops to, just over $29,000. So 50% of the returns were lost just by missing, those best 10 days, right? So when I love the headline of this chart, right? Time in the market, not timing the market. Right? Because again, you pull out for just the best 10 days, and I get it, right? I have an investment account as well. When I get my statement and it's lower than the previous month, I don't love that, right? But I know that if I try to, I'll sell out today because it's going to go lower and I'll buy back in. Look, over a 20-year period, if you just missed 10 days, you lost 50% of the returns, right? So as painful as it can be, your bad behavior can make it even more painful by trying to time the market, get in, get out, right, at the right times. You have to make a lot of correct decisions to do that effectively. Not only do you have to sell at the right time, but you have to get back in at the right time, right? So even, let's give you the benefit of the doubt and say you do sell out of it at the perfect time. Well, you need to buy back in at the perfect time, or else you're giving up all of the good work that you just did, right? So it's not just a one-sided equation. You have to complete that by not only selling at the right time, but rebuying at the correct time. It's not an easy game to play. That's why there haven't been a lot of very, very popular, very, very successful speculative asset investors. Buy at one price, sell at another, repeat the cycle for an entire career. Virtually nobody's done it, right? Now, it gets worse and worse, right? If you missed the best 20 days or best 30 days or best 40 days or best 50 days, you just continue to diminish the returns over time, right? So yes, it's painful. Yes, it's not fun watching your account balance slip, right? However, if you get out and you miss a couple of just the best days over a multi-decade period, what you do is diminish the returns significantly, right? So just ask yourself that question. Am I certain that I am going to be in the market for those 10 best days if my strategy is to buy at one price, sell at another, buy again, sell again, etc. Right? If you just miss a couple of those days, you are going to cut your returns drastically, right? And to that point, and let me bring up another chart that I think is pretty profound, pretty impactful. This is since 2015. The S&P 500 returns are the blue bars, right? And the investor or retail investors are the black bars, right? And this study's been done 100 different times. This happens to be from JP Morgan and Bloomberg, right? But there's Dalbar studies. There's plenty of other studies that say the exact same thing. The investment, on average might have gotten 10%, but the investor on average got 4.5%, 5%. Why? Right? Because they did what we were just talking about. They tried to sell when the market was going down, and then the market starts recovering and they buy back in because they're comfortable now, right? Well, your emotions, your behavior, right? Your investor behavior around the actual investment itself diminished the return, as opposed to if you just would have stuck it out and worked through the turbulence, you would have gotten significantly better returns, right? Last year was the second worst year on record for retail investors, right? And I bring this up because I know the returns in our clients' accounts, right? I know that they didn't just get, 8, 9, 9.5, 10% return, right? Because we had conversations, we had planning conversations, the behavior stuck in there when sentiment to begin the year was not strong, right? Sentiment to begin the year was, well, I don't know if the S&P is going to make it. I don't think it could go much higher. We have a lot of pressure from the markets, and it's an election year. And are we going to be able to do it? Nope. Market went up about 20, 25%. Again, depending on the index that you're discussing here, right? But the average retail investor got less than half of that because they inserted their behavior trying to buy at one price and sell at another, right? It's a very, very difficult game to play. And all of the evidence, all of the studies, right, from the largest asset managers, the largest financial institutions in the world are reiterating this, that bad behavior diminishes returns more than the investment product itself would. Right. And again, I think we have some great questions that I want to get to, but I think those are really important points.
I thought
Hey, Wesley.
Hey guys.
Yeah, Wes, I don't know that we've ever chatted about this chart, right? But last year, in the past decade, was one of the worst years in the last 10 for retail investors, right? And if you can recall, it was a lot to do with like the sentiment to start the year, right? It was an election year, people were nervous about that, et cetera. Well, the index went up, 20, 25%, but the average retail investor got a little less than half of that, right? And just reminding people of, hey, the time in the market and missing just a couple of good days can drastically reduce the return, right? And it was all behavior related. So I sympathize, right? Because as human beings, we want to stop the bleeding. We want to stop the bad, right? That's why, us as humans are still here today, right? We have evolved to make sure that we cut the bad as soon as possible. But when it comes to investing, that type of approach, that type of behavior is actually our worst enemy, right? And the studies, the statistics, right? All of the evidence supports that.
Yeah, absolutely. And I apologize to everyone. I had to go on a conference here, so I'm in a booth. Can you guys hear me okay? Colin,
Yeah, we
can
can
you
hear
okay?
you. Coming
All
in
right,
loud.
perfect.
Yep.
Okay. So if it's okay if I riff for a little bit, if you don't mind. Obviously, I'm assuming you guys had conversations about the tariffs and everything. Maybe if you don't mind, I'll give my commentary. So number one, just obviously there's market volatility, and that's just part of it. As everybody on this call knows, that is, that's just part of the system here. And to that end, this is exactly why you want a multi-phase portfolio, short-term, medium-term, long-term. I'm sure like the guys have already brought up to. In addition to that, if we zoom out and we sort of think from a macro level, this is also why, so we build in agility to the portfolios for that reason. So if something, is volatile for whatever the context or the circumstances, that your portfolio has agility. If you call us and say, hey, it needs money, okay, great. We can take it from this portfolio, this portfolio, depending on whatever the circumstances are macroeconomically. The second thing is that word agility is super important. The things that you are invested in from a long-term asset perspective are public companies. Literally, those public companies, the reason we invest in them is for their agility power. So depending on how these tariff conversations go, I promise you, and not promoting this company, I always just use them as an example. Costco will figure out how to counterbalance whatever's going on from a macroeconomic standpoint. So if all of a sudden it's more expensive to produce whatever goods and services over X, Y, and Z over here, they will produce those goods and services over at A, B, C, D. So agility is a really important factor. And in fact, I've had this conversation with the guys not too long ago and taught it in the last class. One of my critiques, to sound nerdy on this, one of my critiques on Monte Carlo simulations for retirement planning, for those of you who don't know what it is, it's basically one of the core engines of statistical analysis on retirement plans. One of my big critiques on Monte Carlo simulators is they don't allow for agility. I prefer Black-Scholes modeling instead. That's just nerd speak for Black-Scholes allows for pivoting. So when you're in retirement, if your long-term portfolio is going through a little bit of volatility, okay, we can take from a medium-term portfolio or a short-term portfolio. It allows for that pivoting, aka agility. So you have agility. Keep repeating this word because it's an important word in today's market. You have agility in the portfolio, and the portfolio itself also has agile attributes in addition to it. Now, the second part is this is the exact reason that we do not invest typically in individual companies or individual anything. Why? Because if you think about, let's zoom out to like a 2008. Number one, when the whole world is volatile, it's a bit easier going through it because you're like, there's nowhere that I could go. Everybody's going through the same thing. There's a macroeconomic trend that's happening right now. So I'm going to ride it out. That it feels a lot different if you just have one company and it's a unique holding and that's just down for whatever, 50, 60%, and there's no good explanation for it, but your entire livelihood is riding on it. I don't know the with not being invested from a diverse perspective. But number two, what happens is if the macroeconomic climate is seismic enough, let's say like a 2008, then there are other forces that can come to the rescue. As an example, in 2008, the Federal Reserve stepped in, right? Changed monetary policy. And what probably should have been a 10-year recession was a 4.5-year recession. That's not going to happen if you have your money in a handful of stocks, right? This is another reason why, again, we want to be fully diversified. We want to have critical mass of assets. Okay. Third point is and I'm not political at all, as most of you know, so I'm going to say a bad word here, maybe to some people when I bring up Trump. But if I had to zoom out and just look at, okay, and I always want to give you guys my personal opinion, do I believe in the conversation that's happening politically, geopolitically right now? And while I'm not an expert on tariffs, I can actually see an argument on, hey, some of these trade agreements that we have from a tariff perspective, is it not reasonable to suggest that they should be reciprocated? If you're going to charge me 35%, no problem. I'll charge you on the other direction, 35%. Is that fair? And if you get upset about that, then I might say, well, wait a second. Why are you getting upset about it? Now, so I can actually see the value in reciprocal tariffs, unless there's a strong argument as to the counter argument. The second thing is, just to be really clear, I definitely wish Donald Trump's tone was better on communicating this. Like, to me, that's where I kind of get a little bit offended. I would have wished a leader would have gone about it in a more diplomatic way, more respectful way, because the last thing I want any other countries thinking about in terms of America is, oh, they're just bullies. I would not want that associated with me personally. I would not want that associated with the country that I live in. So I can empathize with with people who are upset about his tone. Totally agree. But then also the third, on a positive point, I was thinking about this a couple nights ago, and I was like, it's pretty interesting. If we were to shuffle the shuffle the cards and we onshored more American-based business, because when I think about what's happened with Detroit, when I think about what's happened with Pittsburgh, et cetera, while America as a whole has dramatically increased its prosperity, there are certain places that are just scorched earth because we moved entire industries out to lower cost countries. And that does have I think what some would assume devastating effects. I mean, if some people on here probably have family members who live in those areas, and then those economies, those microeconomies have never really come back in any meaningful way. So I can see an argument to onshoring as much as possible, to protect our own citizens and also to secure supply chains. So if you look at, what happened during COVID and other economic time periods where we had supply chain issues because we outsourced things. And then when push comes to shove or certain circumstance hit our shores, we can't have production anymore because of whatever reason. So I can see a benefit in onshoring. And then the final piece to this is for me, and I'm not necessarily saying that, okay, I holistically agree with increasing tariffs. I'm not making that macro statement. What I am saying is I can see some of the underlying arguments. There's also a bit of a moral thing for me personally when it comes to tariffs. If the cost is so low to an outsourced provider, it is not uncommon to hear stories as to why it's so low. So probably the most classical example with American-based companies, if you look at Apple and them using Foxconn as their outsourced vendor for manufacturing, and then you get some reporters who go over there and like, oh, these conditions are horrible for those people. So I think there's a bit of a moral component as well. If we're at 2 arms distance away from the actual manufacturing process, there's a chance that we're almost practicing willful blindness because it's like, hey, those standards are not American standards and might not even be humane standards, but that's not us. That's the vendor that we're using. So I don't know, you, Colin and Joel, what do you think? I know I'm kind of word salad all these things, but I want to make sure I got my opinion out there and you guys can agree or disagree, but it's my honest point of view.
No, I largely agree. The bully ball tactics, not necessarily for me. On like taking at face value, a reciprocal agreement seems relatively fair, right? Never really got much into thinking about. I thought it was a very interesting point about economies like Detroit and Pittsburgh, right? And it's like the actual result of outsourcing some of this stuff has actually devastated American economies, which is kind of anti some of the pushback that people are giving right now. Of like, oh, this is actually going to hurt America and that type of stuff. Well, you can actually argue the initial action. I think based on that perspective, you could argue that the initial action is what hurt America, not the today's response to maybe try to rebalance or even things out. The moral component is also interesting. You read those stories and you see those headlines and like, personally for me, I just kind of want to bury my head and not think about it. But that's not, that doesn't save anybody in some of these countries that are, that's a slippery slope to go down, right? I think it wouldn't be hard from a moral perspective to make the argument that like, hey, bringing some of this back to America where, relatively speaking, we have, probably better standards than most, if not all of the world, right? In terms of labor conditions and laws and regulations that you have to go through, et cetera. I could see how you could quickly or easily make a moral argument for bringing it back on shore, doing it domestically as opposed to, asking Mexico or, Venezuela or China or whoever it might be, to do that on your behalf. So yeah, we did start the call with that though, Wes. That was that was a good kind of perspective and bringing it full circle, because it's on the top of everyone's call, on top of everyone's mind on this call, and certainly on the other clients that we serve who can't make the call. It's obviously a point of a point of emphasis and a point of conversation today.
Yeah, absolutely. Well, Joel, let me throw you the mic if that's okay. Any perspective on any of the stuff that I've said?
Yeah, I think, well, there's, in lieu of me going on and talking about things I really don't know about, it's probably, we have about 4 or 5 questions that people gave that probably speak into some of the issues that we're talking about here. So in the last 5 or 6 minutes that we have, maybe we should just go through those questions. Charlie Wilson asked one originally. I know, I think Colin can answer that one. Nancy asked a really good question. I think we have a definite philosophy on that.
Yeah, there's a
What
couple
are your
here that we
thoughts,
can
John
chip
G?
away.
Let's go rapid fire and answer all
Yeah.
this so people get the answers they're looking for here.
Yeah. So spot on, right? If we were comfortable buying 2 months ago, you should be even more comfortable buying today, right? If 2 months ago eggs cost $8 a dozen and today they cost $6 a dozen, who would be uncomfortable or unhappy buying at today's prices as opposed to a couple months back? No different than when we're making an investment. This isn't starting to signal a buying opportunity, not the alternative, right? John, what are your thoughts on in 2020 when retail traders seem to have done better? My thoughts are that was 1 out of 10 years, right? They did better than the S&P.
Good for
Yeah,
them.
good for
Good
absolutely.
on them.
It's just not the pattern, right? It is the massive and obvious anomaly, right? And we were just looking at the last 10 years. It's been true the last forever years, right? That we have studies that go back much further, tracking investment versus investor return and them not equaling up, right? And the investor has about 50% roughly on average the return that the investment has because of their behavior. Another great question, and Wes, I know you'll have some thoughts on this. Given that some economists feel like we've reached peak globalization after all the smoke is over, and they have maybe some desire that there will be deglobalization, do you think there are any opportunities in foreign markets relative to domestic market for investment opportunities? I could give you my quick perspective in that I think this is less important today than it was historically because we are such a connected global economy, right? So easy example is Nike sells more shoes in China than it does in America, but they're a U.S. based company, right? So I actually don't think you miss out on a lot of global activity by investing in United States companies, just because if you're good and you can do a great job serving the U.S. market, the natural result of that is you expand to additional borders, right? And maybe to double click on that real quick, we also have the strictest rules and regulations from a financial perspective, even though the headlines might make it seem differently, right? We have auditing, we have rules, we have regulations that public companies have to abide by. They have to make their financials public, right? Whereas when you start, I can give you an example of somebody I know that at the beginning of the Russian-Ukraine war thought he could make a speculative trade in a Russian company, right? It backfired. Actually, the money got locked up, right? It's like essentially seized, right? So now that's a maybe an extreme example of it, right? But that's the risk you take when you start dipping into foreign markets. Not all of them, right? But some of them, right? So Wes, I don't know if you have any comments there that you wanna expand on in terms of is there opportunity in foreign markets today that may not have been there, may not have been recognized in the past?
Oh yeah, well, so I think the first thing is going off of the baseline assumption. There's a phenomenal book on this called The Rational Optimist, which is absolutely outstanding. I recommend everybody read it because it is really fundamental to understanding how your investments and economies work, especially capitalism. So the first thing is the whole, like the peak conversation. We've had peak oil, we've had peak calories, we've had peak humans, we've had peak surface area of land, et cetera, et cetera. All of those have turned out not to be true. And it's not that we weren't trending in that direction. Let's take peak oil, for example. There was a constant conversation not too long ago, a handful of years ago, if not decades ago, about peak oil. We're going to run out of energy. Well, that may have been true until we get more efficient vehicles, until we get fracking, et cetera, et cetera. If you look at a company, what was the oil company I was looking at? The oil company I was looking at a handful of weeks ago, to put it in perspective, in 2010, I believe they were producing 4 million barrels of crude oil, I believe it was, per day. And now, in 2024, they produced 13 million barrels per day. 5 million of them only came from traditional drilling. The remaining came from fracking. That was not predicted 10, 20 years ago, more than that, when we predicted peak oil. And I could go on and on down the list. So I'd be really careful of making the general assumption that we have peak anything, because one day capitalism does, a problem reaches sort of critical mass, you then have an intersection of problem is now big enough, and incentive therefore is also now big enough to solve the problem. And capitalism is not perfect, but that is what capitalism does, is it provides incentive to humans to actually solve the issues. Now, to the second part of the question, do I want to therefore go outside of US borders for opportunities? The answer is yes, comma, with American companies, for the exact reasons that Colin said. Don't quote me on this, but I believe like McDonald's receives, I don't know, probably 60, 70% of its revenue outside of US borders. So you get the benefit of going global and getting, making sales and revenue all over the world. But at the same time, you get the protections of GAAP accounting principles, of the scrutiny of analysts, et cetera. Versus it's not that, as a counterexample, if you look at some place like China, it's not that there's not growth going on in China. It's just that we can't trust the numbers, right? Like almost every time I research Chinese companies and I start to hear commentary of like, oh, they recasted the numbers, or we couldn't trust those numbers, et cetera. Well, we don't want to put our investors in that position where you're investing in what looks to be a great company, but oops, they lied on the data. So that's my perspective. Yes, definitely taking advantage of external borders to US, but doing it with US based companies because of the standards and the rigor and the quality. Do we have another question? Oh, sorry.
One final question that I think is very important. Charlie brought up, is this the time to start considering Roth conversions? Here's the opportunity that we've been kind of working towards this entire time, right? This is a huge benefit when we marry it with the way that we invest. Yes, now that share prices are 10% lower than they were at all-time highs at the end of last year, right? We can convert a larger amount of shares for the same tax bill, right? Because the price of those shares are what the IRS tax. They don't tax the number of shares. They tax the total value of those shares on the way over. So yes, and there's actually multiple clients on this call that we've executed Roth conversions for, partial Roth conversions. What I wouldn't want you to do is do your entire Roth conversion today, right? Because you might miss out on opportunity throughout the course of the balance of 2025 to do more and more tax planning, Roth conversion opportunities. So yes, Charlie, that your thinking is spot on, right? This presents an opportunity on the tax planning side of things, as opposed to the growth of accounts. When markets are up, nobody's upset. I'm certainly not rooting against that. But when prices are suppressed like they are today, this is right about the time at a 10% correction where we start to engage in these conversations and start to think, okay, do we want to start converting? How much? To what extent? And leaving some room for, if it does go further south, right? We'll take advantage of those dips as well, right? So that is. That can be an entire roundtable in and of itself, where we walk through an example of that. But if you're thinking that way, give us a call. It would certainly be something to explore, even if we explore it and say, hey, now's not the time, for one reason or another. But yeah, at a 10% discount, that's when the first kind of alarm should ding. And we should start considering, hey, is there an opportunity from a tax planning side of things to have that discussion? Any final statements? Any closing thoughts? Any additional questions before we put a ribbon on today's roundtable?
Final piece for me is, I really love having all of you guys show up. This is the behavior is the hardest part. It's no different than Colin taught me this phrase a long time ago. The heaviest weight at the gym is the front door. And it's very similar in finance, right? That the hardest thing to do is actually to be disciplined enough to ride through volatile markets and to stay put. That's the hardest part. But the prerequisite to doing that is actually the knowledge so you can understand what's happening versus just blindly going through. And it's a little shaky. I'm going to get nervous. I'm going to eject right now. That's crazy. I mean, a lot of times that's financial suicide. And that's where people get these stories of, oh my gosh, I got crushed in the stock market. It's like, no, you chose to eject at the worst possible time. You do not want to do that. You own very sound, fundamentally based companies that every single day, every single minute of every single day are selling in the global market, increasing revenue over time. That is purely their objective. So that's my final words of wisdom.
Dad?
Yeah, fantastic. I'm just, again, reiterating what Wes just said. Thankful for everyone on the call. We hope we brought value to you. We hope you got something out of it. And if they brought up any other questions, call us and we can talk through all of it.
Yeah.
Awesome.
And for those of you who are, if you're really unhappy with Trump and really angry and want to talk to somebody about it, just call Colin directly, preferably after business hours and on the weekends, ideally on Sunday. Yeah. So just as a heads up.
Yeah.
Oh,
Please.
Yes, sir.
Hello. Hey, when I was talking today, it's been a while, but I asked him about the president at one time, the last election, and he said, don't worry. He said the companies that we're investing in, the owners of the companies we're investing in are smarter than the president.
Fantastic line.
Fair point. Yeah. Really good point.
And
That's
I
what
know
it
this
told me.
guy, yeah, that's a fantastic point. I know this guy has gotten, politicized. There are very few Elons. Love them, hate them, or feeling differently, right? There are very few Elons that would leave being CEO of companies, right, and get involved in politics. And there's a reason that there hasn't been a pattern of this, right? There's plenty of business leaders out there that can make a serious political run or be put on cabinets or have positions in administrations, et cetera, that decline year after year, president after president, right? Because being CEO of Chase Bank is a much better gig than having to deal with the crap of being the president of the United States, that comes with that, right? Man, Dave blessed us with that one. Thank you for sharing that. That's a fantastic line.
He blessed me. He blessed me for the last 40 years, you know?
Amen.
But he did say that 4 years ago when I asked him. Said, don't worry, man. That's cool. I'll never forget it, And then I listened to one last thing. From listening to you guys, I keep my mouth shut by listening to you guys, keeps me calm. And it's all leading up to this. And I think we made some adjustments that I'm in a pretty good place. I feel good, And I haven't, in the last couple of weeks, I haven't even been looking at anything because I was going to wait for this meeting. So I don't get caught up in it. Everyone gets caught up. I'm not a greedy person. But I'm blessed to have you guys and Dave too. And thanks, man. This really makes a difference. I look forward to these meetings. And I'm quiet and I'm not the smartest guy, but you guys are smarter than me. And maybe the president too.
Sincerely, thank you, sir. I know that you really appreciate it as well. So thank you very much. It's an honor for those compliments. And it's an honor to serve all you guys.
And now, hey, you can get back to your slot machine, bro.
Yeah.
I'm waiting for in a month, man.
Oh, heck yeah.
I'm
Looking forward to it.
It's going to be an awesome day. Ciao. Ciao to everyone.
My last words are just remember, when anything good happens, that's my fault. When anything bad happens, call Wes. Right? So yeah, call me with the president stuff. That's fine. But when the markets are dropping, Wes is the guy you guys want to talk to.
Thank you guys. Love you
All
guys.
right, Thank you so much.
Thank you guys.
Have a great day.